In this video we are going to talk about dividend stocks for your life. So before starting, please like this video and subscribe to this channel for our future updates. The most compelling aspect of dividend investing, in my opinion, is the prospect of receiving continually growing distributions in exchange for holding your shares. Dividend income and the raises that come with picking outstanding companies are completely passive investments, with the exception of the initial study and the periodic monitoring of your investments on your behalf. The companies in which you have stock do all of the labor, and you get the benefits as a result. The best dividend stocks are typically those that have significant competitive advantages and are the dominating players in their respective industries, according to research. They also have a lot of room to expand in the future as well. Here are 3 dividend companies that fit these requirements, and that will most likely continue to pay dividends for several decades to come. Number 5. Procter Gamble, 2.5% dividend yield. Almost any of the thousands of goods manufactured by Procter Gamble, NYSE, PG, and sold under its 65 distinct brand names can be found in your bathroom or laundry room if you look hard enough. The firm, which is a worldwide conglomerate, sells household supplies to families all over the world through its online store. In addition to Pampers and Tampax, the company distributes brands such as Bounty and Gillette as well as NyQuil and Suave. Other products handled by the company include Olay, Head & Shoulders and Old Spice as well as Tide. Items that you most frequently purchase at the grocery store on a monthly basis, often without giving them a second thought, are included in this category. Even if you are experiencing financial difficulties, you will most likely continue to brush your teeth and wash your clothing. Nevertheless, other expenses on your budget will most likely be the first to be reduced or eliminated entirely. Procter & Gamble has maintained extraordinary stability, while growing its dividend every year for the past 65 years, as a result. With more than $15 billion in free cash flow created over the past 12 months and barely half of that used to pay dividends, investors can expect dividend payments to continue for years to come from the company. Number 4. Johnson & Johnson. It accounts for nearly a fifth of global GDP, making healthcare one of the world's largest and most vital sectors. Our health is a top priority in the federal budget, and the conglomerate Johnson & Johnson, NYSE, J&J, has a huge impact in that part of the economy. Not only does it have a global presence as one of the world's top pharmaceutical companies, but it also boasts 13 products with yearly sales of $1 billion or more. The company offers a wide range of products for a number of applications, including surgery, vision care, wound care, and other medical procedures. If you go to your local drugstore, you will be able to find the company's items such as Tylenol, Motrin, Benadryl, Band-Aids, and Listerine. Among those working in the healthcare industry, Johnson & Johnson is virtually ubiquitous. The company has been able to continuously put money in the pockets of investors as a result of its considerable influence in that industry, increasing its dividend for the past 59 years in a row and boosting its dividend payout ratio. More than $22 billion in free cash flow has been created by the firm over the last 12 months, with slightly less than half of that amount being spent on dividend payments. See chart. Number 3. Medtronic. Operating as the world's largest pure-play medical equipment company, Medtronic, NYSE, MDT, has the capacity and scale to be relevant for decades to come. The company has a $166 billion market capitalization and operates in more than 100 countries. Medtronic's chairman and CEO, Jeffrey Martha, indicated in his opening remarks during the company's first quarter 2022 earnings call that the firm will increase its research and development (R&D) investment by 10% over the previous fiscal year, which saw the business spend $2.49 billion on R&D. According to Martha, it is precisely this commitment to innovation that has enabled Medtronic to introduce more than 190 new products around the world in the last year alone, a figure that includes a variety of medical devices. It is due to Medtronic's flurry of product introductions, which are powered by the company's dedication to research and development, that analysts are forecasting roughly 9% annual profit growth from the stock over the next 5 years. Due to an estimated payout ratio in the low to mid 40% range for this fiscal year, and strong growth prospects, Medtronic appears well-positioned to continue its 44-year streak of dividend increases. In addition, despite its superiority to the entire S&P 500 index, Medtronic trades at a forward price-to-earnings ratio of 21.2, which is lower than the S&P 500's forward price-to-earnings ratio of 21.3. For dividend investors seeking a high probability of long-term income, Medtronic and its 2% annual yield represent a solid choice, particularly for those seeking income that will last a lifetime. Number 2. Visa. Visa, NYSE, is a significant payment processing corporation that derives the majority of its revenue from the volume and number of payment transactions processed by it on behalf of consumers, governments, and enterprises. Despite a harsh environment induced by COVID-19 that continued to have an impact on consumer buying habits in the company's previous fiscal year, Visa's net revenue increased 10% year-over-year to $24.11 billion, and its non-GAAP earnings per share increased by 17% to $5.91 per share. Visa's non-GAAP earnings per share growth corresponded to the company's 17% increase in processed transactions, which reached an amazing $164.7 billion in the company's most recent fiscal year. Due to rising COVID immunization rates and Pfizer's game-changing outcomes with the oral COVID-19 pill, Visa should see a rapid return to its growth story in the years to come. This should serve as a positive reinforcement for Visa's payment volumes and transaction volumes in the future. As a result, analysts estimate Visa's non-GAAP earnings per share to climb by 19.3% in the company's new fiscal year and by 16% annually over the company's following 5 years. Despite the fact that Visa's dividend yield is currently only 0.7%, this is more a reflection of the company's fast stock price growth at the time of this writing. With Visa's low payout ratio and solid growth forecast, the company should be able to increase dividends at a faster rate than the stock market, as evidenced by its recent 17% dividend increase. Number 1. McDonald's. McDonald's, NYSE, MCD, famous golden arches have a global brand recognition rate of approximately 90%, according to the company. It is because of this unrivaled brand recognition in the business that its 39,676 restaurants around the world have become a constant in the routines of their customers. Moreover, with 93% of its locations being franchised, McDonald's irreplaceable brand is what allows the company's low-risk business strategy of collecting rent and royalties based on a percentage of franchisee sales to succeed. Furthermore, it was this aspect that enabled McDonald's to issue a 7% dividend boost to its shareholders in September. The dividend increase marked the 45th consecutive year in which the firm has increased dividends to shareholders and stockholders. McDonald's is a dividend aristocrat because it is a component of the S&P 500 that has increased its dividend for at least 25 years in a row, making it a dividend aristocrat. And, with analysts forecasting that McDonald's would expand its earnings per share, EPS, at an annual pace of 11.9% over the next 5 years, the possibility that the corporation will eventually enter the ranks of dividend kings in 5 years is considerable. It is projected that McDonald's dividend payout ratio will be in the mid-50% level this year, which should allow the business to continue to grow payments by high single-digit percentages in the years to come. McDonald's 2.2% yield, which is greater than the market average, can still be locked in at an affordable price considering the company's quality and growth prospects, despite its post-earnings surge. McDonald's trades for $255 a share, or 25 times the average profits per share projection of $10.06 for next year. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.